Hi, I'm going to be demonstrating how to prepare a bank reconciliation using PA 5-3 on page 243 in your text. It's also the first problem in the Chapter 5 practice problems in Connect. If you have not yet read the Chapter 5 or watched the interactive presentation for Chapter 5, please do so before you watch this demonstration. Also, you can use the blank template I provide in the Module 2 folder, Chapter 5 folder within Module 2, to record the solution to this problem for your later use when solving your homework problems, if you'd like. Okay. Banks provide three control activities over our cash. They restrict access by providing a safe place to store our cash. They provide a documentation of all transactions that occurred with regard to our cash at the bank. And finally, through preparing the bank reconciliation, they provide an opportunity to independently verify the amount of cash we really have. Before you on the screen right now is an example of a bank statement. This was the December statement prepared for Stewart Company by their bank. You'll notice it's a chronological or date order record of all the transactions. The checks are reductions of the cash account. The deposits are additions to our cash account. And in the other category, we can see both additions and subtractions. You'll know they're additions or subtractions by looking at the balance and then noticing what happens to it. A balance of $48,000 less a check of $500 gives you a new balance of $47,500. Another check written for $7,000 reduces the balance to $40,500, and so on. Below the bank statement is the cash T account in our records, in Stewart Company's records. Remember, cash is an asset on the left side of the accounting equation, so we record increases on the left or the debit side, and we do the opposite to record decreases. So checks are recorded on the credit or right side, debits and record increases to cash. To find the balance on December 31st, we took our beginning balance, added the debits, subtracted the credits, and we got our ending balance. Okay. Our problem asks us to first identify and list deposits in transit, and that would actually be the first step of a bank reconciliation. A deposit in transit is a deposit made so late in the month that it didn't make it onto this month's bank statement and will appear in the next month's bank statement. If a deposit is missing from the middle of the month, then it's a lost or missing deposit, and you should notify the bank. Okay, so what we're going to do is, working from our list of our deposits, we're going to see if the bank has deposited each one that we say we have deposited. So December 11th, $28,000, the bank received it. December 23rd, $36,000, the bank received and deposited it. December 30th, $19,000, the bank received and deposited it. December 31st, $13,000, and it's not on the bank statement. That is our deposit in transit. So we're going to check off this box. Now, if you see a time delay or a few days lag between the day that we make the deposit and the day that the bank records it, in other words, if these dates don't match the deposit date, the deposit dates, don't worry, because sometimes there is a lag. The bank changes over its day of operation about 2 or 3 o'clock in the afternoon. So for example, on December 11th at 3 o'clock, it's going to change its records to December 12th. So you may see a lag. Also, if a deposit was made at the end of the month, over a weekend, you'll see that deposit show up in the next month's bank statement. Okay, so we have our deposits in transit. Let's see if all of the checks we wrote have been cashed or cleared. If they have not, those are called outstanding checks. So we're going to compare every check we wrote to what the bank has cashed. Okay, so this first column is our check column. I'm going to have to scroll down a little bit just so that we can see everything. Okay, so according to our records, we wrote a check for $500. It was cashed by the bank. Check for $7,000, cashed by the bank. A check for $120, it was cashed by the bank. A check for $550, cashed. $1,900, cashed. $12,000, it was cashed. And we've got one at the very bottom there for $2,200, and that was indeed cashed a little bit later. A check for $60, it was cashed. A check for $900, it was cashed. So far, everything has been cashed. A check for $17,000, cashed. A check for $1,650, and it was cashed or cleared the bank. We are missing two checks though, $150 and $4,500. They did not clear the bank. They were not cashed. Those are called outstanding checks. So we're going to check off the checks for $4,500 and for $150. They have not been cashed. They're called outstanding checks. Now just a word connecting us a little bit closer to reality. In reality, your bank statement would be listing check numbers, and so would your cash account. And in fact, you may even be receiving your bank statements electronically rather than in paper form. What I usually do, and what I did when I was a bookkeeper, when I was in high school and college, is I would put a check mark next to every check that was cashed and every deposit that was indeed deposited on the bank statement, so that I knew what remained unchecked was a reconciling item, either deposit in transit or outstanding check. So everything that we have in our cash account is either on the bank statement or it's going to go on the bank reconciliation as a deposit in transit or outstanding check. There are these things that have not yet been put into our bank account, and there'll be another reason why our cash account does not equal the bank statement ending balance. And so what we're going to do is prepare a reconciliation now. A bank reconciliation is an internal report prepared to verify the accuracy of both the bank statement and the cash accounts of a business or an individual. So what we're going to do is try to come to agreement as to exactly how much cash we have in the bank so that we can report that on our statement of cash flows and on our balance sheet. We start by putting the ending balance for the bank statement on the left side and the ending balance for the cash T account on the right side for the same date, December 31st. So let's get those amounts. The ending balance of the bank statement is $86,720. The ending balance of our cash account is $95,470. Let's put those on the bank reconciliation. Remember to choose the ending balance for the same date. Okay, now let's put on the bank side things that we did on our books that they didn't know about. What are they? Well, deposits that we made that they don't know about yet because they were made so close to the end of the month that they were not recorded in this month's bank statement. And also checks that we wrote that they don't know about yet because they haven't been presented for payment. Those will always be reconciling items on the bank statement side. Okay, and we have those listed above here. We prepared that list earlier. We had a deposit in transit of $13,000, and we had outstanding checks of, if we add these together, $4,650. Now again, in the real world, we would list our deposits in transit separately because we may have several, including the date. And the outstanding checks would be listed separately, including the check numbers. Okay, so now everything that's in our cash T account is either on the bank statement or we've added it to the bank side of the reconciliation. Now, is there anything that the bank did that we don't know about? Well, these items here. I don't see an NSF check deducted here. I don't see interest earned added on to the debit side, and I don't see a $150 service charge deducted. I do see $150 here, there, but that was for a check that was written, so it's not the same thing. These three things are not yet in our cash T account, so we need to put them on our side of the bank reconciliation to make sure the information that we have at the bank and on our records matches. So we're going to add the interest earned, $50. We're going to deduct the NSF check, $300, and we're going to deduct the bank service charges for $150. Now just a quick review of what those are. Sometimes bank accounts yield interest. The bank will give you interest for the use of your money while it's in a checking account. This is rare, but it does happen. An NSF check is a check that has bounced. Your customer, J Left, had given you a check, and it was included in the earlier deposits. But when your bank went to Customer Left's bank, Customer Left's bank said there's not enough money to honor this check. So since the money was already included in a deposit, the bank came back and deducted it. And now we have to deduct it too and pursue payment with Customer Left. Bank service charges, those are charges that the bank yields against you for processing your checks and processing your deposits. So we have to also deduct that since they have deducted it above. Now there's an Excel function in here, and it added the additions, it subtracted the deductions. Our balance according to the company's books now would be $95,070. And on the bank side, when we add the deposit in transit and subtract the outstanding checks, also we get a balance of $95,070. So the reconciled amount, the amount that should be in the cash account, is $95,070. However, right now the cash T account still says $95,470, right? Right there. So we need to do journal entries for the book side to make sure that those items, things that the bank had done that we do not yet have in our records, we have to make sure we do journal entries for those items. Okay, first one, in addition to cash. To increase cash, we debit cash. Cash is on the left side of the accounting equation, so we debit, or left side, to increase cash for 50. And since this is interest earned, we'll call it interest revenue. Let's record that and do our next journal entry. We're going to record the second item on our bank reconciliation, which is the, bank service charges, I believe, is the next entry here. They want us to record service charges of $150 deducted by the bank. If it's a subtraction, we'll do the opposite and credit cash for $150. What will we debit? Well, our book tells us to debit office expenses. Other accounting books tell you to debit miscellaneous expense, but in the real world we would use something like bank service charge expense so that anyone reading the financial statements within the company will see how much the bank is charging you for the services that they provide. It's usually a very significant amount. So we wouldn't usually group it with office expenses, but our textbook chooses to do so. The last item is the customer's check that bounced, non-sufficient funds check. Okay, so we have to think back to what we did with the original transaction. In the original transaction, when we received his money, we debited cash and credited his accounts receivable account to reduce it for the amount that he paid us. But in effect, he did not pay us. The check was not good. So we need to put back his accounts receivable account and credit cash for $300. And we've journalized all our reconciling journal entries for the bank statement. Notice that each of them involves cash, either a debit to cash for additions or credits to cash for deductions. Now you can set up a T account with your ending cash balance of $95,470 and then post the journal entries you just made, just to make sure that the ending balance does match your reconciliation. Last couple of questions here. It asks you what should be, after the reconciliation journal entries are posted, what should be the balance in the cash account? That should be $95,070. And then finally, if the company also has $300 of petty cash, how much should you report in cash and cash equivalents? Well, we would group the two together. We would report all cash together unless it's restricted. So $95,070 plus 300 equals $95,370. And that finishes our problem. You can try the next practice problem or go on to your homework. Have a great day.